Something is moving beneath the surface of the precious metals market, and most silver stackers are not watching it. They are watching silver, they are watching gold. But the real warning is coming from platinum. A metal once called the rich man's gold has quietly fallen more than $1,000 from its January high. And history shows when platinum breaks like this, silver rarely stays calm for long. The question is no longer if this shockwave reaches silver, but when. And by the time most stackers notice, it may already be too late to prepare. Welcome back to Precious Metals Intelligence. If you're new here, this channel exists for one purpose: to help serious, wealth-conscious viewers understand the strategic forces moving behind the headlines. There was a time when platinum was called the rich man's gold. It was rarer than gold. It was harder to find. It was harder to mine. For decades, it carried a higher price than gold, and it stood as a symbol of wealth that even gold could not match. Bankers wanted it. Jewelers wanted it. It sat at the very top of the precious metals world, above silver, above gold, above everything else. But today, that story has changed. 1 ounce of gold can now buy more than 2.5 ounces of platinum. The metal that once looked down on gold now trades far below it. And for many investors, this shift alone raises a serious question. What happened to platinum, and why does it matter now? To understand the answer, one must look at the numbers. In late January of 2026, platinum futures reached a record high of $2,725 per ounce. It was a powerful move. It followed gold and silver upward, riding the same wave of strength that had lifted the entire precious metals market. Many believed platinum was entering a new era, one where its old status as the premium metal might return. But that strength did not last. By July 1st, platinum had fallen to $539.60 per ounce. This was a drop of 47.4% from its January high. In plain terms, platinum lost nearly half its value in only a few months. That is not a small correction. That is a collapse. For someone unfamiliar with the metals market, this may sound like nothing more than a price swing. Metals go up, metals go down. But those who study these markets closely know something important. Platinum does not move alone. Its price swings often carry warnings for other metals, especially silver. This is because platinum plays a special role. It is what analysts call a bellwether. A bellwether is something that signals change before the change is fully seen. In the world of precious metals, platinum often moves first, and silver follows later. When platinum breaks down sharply, it is rarely just platinum's problem. It becomes a signal, a quiet warning that the forces pressuring platinum may soon reach silver as well. This is the heart of the concern facing silver stackers today. Many silver buyers watch gold closely. They watch silver charts every day, but very few of them watch platinum. And that is exactly why this moment deserves attention. The metal that most people ignore may be the one giving the clearest warning of what comes next. It is important to understand that platinum is not like gold or silver in every way. It is rarer, yes, but it is also far less liquid. This means it is harder to buy and sell quickly without affecting its price. When platinum moves, it often moves with more force, more speed, and more emotion than gold or silver. It reacts strongly to economic fear, industrial demand, and global uncertainty. This makes it more unpredictable, but it also makes it more revealing. When platinum breaks down this fast, it does not do so without reason. So the real question is not whether platinum has fallen. That is already clear. The real question is what this fall means for the metals that come after it, particularly silver. History has shown a pattern. When platinum experiences a sharp and painful decline, it often reflects deeper stress building beneath the surface of the broader metals market. Industrial demand slows, economic uncertainty grows, investors become more cautious. These forces do not stay isolated to one metal. They spread quietly from platinum to other metals connected to global industry and global trade. And few metals are more connected to global industry than silver. This is why platinum's story cannot be ignored, even by those who have never bought a single ounce of it. It is not simply a story about platinum's price. It is a story about timing. It is a story about warning signs. And for silver stackers, it may be a story about what is coming next, whether they are ready for it or not. Numbers rarely lie, but they often hide their meaning until someone takes the time to look closely. Platinum's collapse is one of those cases. On the surface, it looks like a simple story of a metal that rose too fast and fell too hard. Underneath, it tells a much deeper story about supply, structure, and the fragile balance holding this market together. To understand where platinum stands today, one must look back further than January of 2026. For nearly a decade, platinum traded in a narrow range, hovering close to $1,000 per ounce. It was quiet, it was stable. Analysts often described it as consolidating, a term used when a metal moves sideways for a long period, building pressure before its next major move. Markets that consolidate for years rarely stay quiet forever. Eventually, they break out, either sharply upward or sharply downward. For platinum, that breakout came in 2025. After 10 years of sitting near its historic pivot point, the metal broke free of its range and surged upward, eventually reaching its record high in January of 2026. For a brief period, it seemed platinum had finally reclaimed the strength it once held decades earlier. But breakouts do not guarantee lasting strength. What follows a breakout often determines whether the move was real or temporary. And in platinum's case, what followed was a steep and painful reversal. The metal formed a pattern of lower highs and lower lows, a technical signal that often warns of continued weakness. This pattern is not just a random shape on a chart. It reflects real hesitation, real selling pressure, and real uncertainty among those trading the metal. Now, all eyes turn to one number, $1,348.20 per ounce. This was platinum's high point back in February of 2021, and today it stands as a critical support level. In simple terms, support is a price level where buyers have historically stepped in to stop a decline. If platinum holds above this level, its long-term bullish structure remains intact, even after this painful drop. But if platinum falls below it, the decline could accelerate, potentially sending the metal back toward its old $1,000 pivot point, erasing years of upward progress in the process. This is not a small technical detail. This is the line separating a healthy correction from a deeper structural breakdown. But price charts alone do not explain why platinum behaves the way it does. To understand that, one must look at where platinum actually comes from. Unlike gold and silver, which are mined in dozens of countries around the world, platinum production is highly concentrated. South Africa alone produces around 120 metric tons annually. Russia follows with approximately 23 tons. Together, these two nations account for more than 84% of the world's entire platinum supply. This concentration creates a fragile foundation. When the vast majority of a metal's supply comes from just two countries, any disruption, whether political, economic, or industrial, can send shockwaves through the entire market. There's little room for error and little room for other producers to fill the gap. Adding to this fragility is the fact that Russian platinum is not even mined directly. It is produced as a byproduct of nickel mining in the Norilsk region of Siberia. This means Russian platinum output is tied not to platinum demand itself, but to decisions made in an entirely different industry. When nickel production shifts, platinum supply shifts along with it, often without warning. This is where platinum's dual identity becomes critical. It is not simply a financial asset held for wealth preservation, the way gold often is. It is also an industrial metal used heavily in automotive manufacturing, hydrogen technology, medical equipment, and jewelry. This means platinum's price is pulled in two directions at once, by investment demand on one side and industrial demand on the other. When these two forces disagree, volatility increases. And when volatility increases in a metal this thinly traded, price swings become larger, faster, and harder to predict. This combination, concentrated supply, industrial dependence, and low liquidity, helps explain why platinum's fall was so severe. It also explains why serious market observers are paying close attention now. A metal this fragile, moving this sharply, rarely moves in isolation. And for those watching closely, the real concern is not platinum alone. It is what platinum's structure reveals about the pressures building quietly beneath the surface of the entire precious metals market. Every metal tells two stories at once. One story is written in charts and numbers. The other is written in politics, war, and the quiet decisions made behind closed doors in distant capitals. Platinum, more than almost any other precious metal, sits directly on top of this second story. And in the summer of 2026, that story has grown far more serious than most investors realize. To understand why, one must return to Russia. Earlier, it was noted that Russia produces roughly 23 metric tons of platinum each year, almost entirely as a byproduct of nickel mining in the remote Norilsk region of Siberia. This alone makes Russian platinum supply unpredictable, tied to decisions in an unrelated industry. But there is a second, more troubling layer to this story, one that has little to do with mining at all. Russia's economy has been under sustained pressure. Its war effort in Ukraine continues to demand enormous financial resources, and its broader economy continues to show signs of strain. Nations under this kind of prolonged economic pressure often turn to unconventional sources of funding. And one such source, historically used by governments in crisis, is the liquidation of strategic reserves. Here is where the story becomes difficult to measure with any certainty. Russia treats its mineral and metal holdings as a matter of national security. This means there is no published data confirming whether Russia holds a significant platinum stockpile, nor is there any public information about the size of such a stockpile if it exists. This silence is not comforting. It is concerning. Markets do not fear what they can measure. They fear what they cannot see. If such a stockpile exists, even a partial liquidation could add sudden, unexpected supply to a market that is already thin and already fragile. A metal with low liquidity, as platinum is, cannot easily absorb a large, unexpected increase in supply without a significant impact on price. This is not a distant theoretical risk. It is a real possibility hanging quietly over the platinum market, one that few casual investors are watching, but one that serious analysts cannot ignore. Beyond Russia, the broader geopolitical and economic landscape in 2026 remains far from settled. Uncertainty continues to surround global trade relationships, industrial policy, and economic growth expectations across major economies. In periods like this, markets often shift into what analysts call a risk-off environment. This means investors pull back from assets seen as higher risk or more industrially sensitive, favoring safety instead. Because platinum carries such heavy industrial exposure, it is particularly vulnerable during risk-off periods. A slowdown in global manufacturing, automotive production, or industrial investment can weigh directly on platinum demand, adding further downward pressure at a time when the metal can least afford it. This creates a difficult tension for anyone trying to understand where platinum goes next. On one side sits the technical picture, which currently leans bearish. Prices have fallen sharply. The pattern of lower highs and lower lows remains intact. Critical support near $1,348 per ounce has not yet been broken, but it has not been tested and held with confidence either. On the other side sits the longer-term structural picture, which remains far more constructive. Platinum still trades above the top of its decade-long consolidation range. Its historical undervaluation compared to gold remains extreme. Its rarity, its industrial relevance, and its long-term supply constraints have not disappeared simply because its price has fallen. This is the essence of nearly every serious market, whether in metals, stocks, or bonds. Markets rarely move in straight lines, even when the long-term direction is clear. Short-term fear and long-term fundamentals often pull in opposite directions at the same time. Someone examining only recent price action might feel platinum is broken. Someone examining only long-term structure might feel platinum is simply resting before its next move. Both views hold partial truth, and both carry real risk if taken to an extreme. This is precisely why platinum deserves careful attention right now, not blind optimism and not blind fear. Its story is shaped by mines in Siberia, decisions made in Moscow, uncertain global trade conditions, and a support level sitting quietly on a chart and waiting to be tested. And whatever happens next in this story will not stay contained within platinum alone. It will ripple outward toward every metal connected to it, especially the one metal known as the most versatile on the entire periodic table. Every market has metals that lead and metals that follow. Few people take the time to study which is which, but those who do gain something valuable, an early warning system hidden in plain sight long before the broader market reacts. In the world of industrial metals, copper has long been called the leading signal. It is often described as an indicator of global economic health because it is used so widely across construction, electronics, and manufacturing. When copper moves, analysts pay attention because copper tends to move first, ahead of the broader industrial cycle. This is why copper is often called the front-end bellwether. It reacts early at the very beginning of the mining and production chain, since it is frequently extracted alongside other industrial metals before those metals ever reach a refined, tradable form. Platinum plays a different role, but a role no less important. If copper sits at the front end of this chain, platinum sits at the back end. Its price does not simply reflect raw industrial output. It reflects the final stage of demand, the point where automotive manufacturers, hydrogen technology producers, medical equipment makers, and jewelers decide how much platinum they are actually willing to pay for. This is why platinum often confirms what copper first suggests. Copper opens the conversation. Platinum tends to close it. This distinction matters greatly for silver because silver sits in an unusual position between these two forces. Silver is not simply a monetary metal, and it is not simply an industrial metal. It is both, at the very same time. In fact, silver holds a level of versatility unmatched by nearly any other metal on the periodic table. It conducts electricity better than any other element. It is used in solar technology, medical applications, electronics, and traditional investment products all at once. No other metal touches this many industries while also functioning as a store of value. This versatility is precisely what makes silver so vulnerable to signals coming from both ends of the industrial chain. When copper weakens at the front end, it often hints that industrial demand is slowing before that slowdown becomes obvious elsewhere. When platinum weakens at the back end, it often confirms that this slowdown has reached the final stages of industrial decision-making. When both signals align, silver is rarely able to remain untouched, because silver's identity is built on the very same industrial and economic forces influencing both metals. This is where the story becomes especially important for today's silver stackers. There is a number many of them watch closely without fully understanding its cause, the gold to silver ratio. This ratio measures how many ounces of silver it takes to equal the value of 1 ounce of gold. In recent times, this ratio has remained elevated, meaning silver has appeared cheap compared to gold, even during periods when gold performed well. Many assume this elevated ratio reflects weakness specific to silver alone, but a deeper explanation may be hiding in plain sight. If platinum, acting as the back-end industrial bellwether, is signaling stress within the broader industrial and economic landscape, then some of the pressure holding silver back may not originate from silver at all. It may be inherited pressure, passed along quietly from platinum's collapse through the shared industrial forces connecting both metals. This reframes the entire situation. Silver's underperformance may not simply be a silver problem, it may be a symptom of a much larger warning system, one where platinum's back-end signal and copper's front-end signal are both pointing toward the same underlying concern. For silver stackers who have spent months studying silver charts alone, this is the piece often missing from the picture. The real warning may not come from silver at all. It may come from watching what platinum does next and understanding that when the back end of this bellwether finally breaks its critical support, silver is unlikely to remain a bystander for very long.